Welcome to Front Range Facts. This is Anthony Meisner.
And this is Jim Marion.
We're here to bring you your national update today, so let's get right after it.
Yeah, we wanted to show you how the market activity in 45 of the 50 largest metro areas has actually increased. So there's more homes for sale right now. As you can see in that darker green trend line, it's moving up further than you've seen in the last few years, like 2023, 2021, 2022, and it's getting a little bit more towards that pre-unicorn years with more inventory, more choices. But we're still down, right, Anthony?
Absolutely. Yeah, if you look at it here, active months of listings in the thousands. This is really interesting because it tends to plateau about the lowest point in the year in March, right?
Yeah.
But look at where we are today. We're almost at the highest point of inventory we've had in the last 2 years.
Yeah, Anthony and I, been talking the last few months about how we kind of expected a delay to the spring market to make it almost seem like it'd be a fall market when we see activity increase because interest rates have been so high.
Oh, they've been really tough right now, right?
Yeah, and we're certainly seeing that right now with the active listings in the thousands, with it being kind of a high watermark versus what's usually a lower watermark in the spring market. So a little bit worrisome from a seller's perspective.
Yeah, it is. Now, if you look here at the new listings of homes, new listings seem to be trending up this year, though.
Mm-hmm.
So this is a good sign. At least seller appetite is continuing to change, which is a good sentiment because we were basically at our rock bottom level in 2023.
Yeah. And for the latest prognostications of where the great minds in mortgage business are kind of feeling things are at, if you haven't been paying attention to the local news, we certainly have more increase in headwinds of those interest rates. They're staying around. They're pernicious for longer because inflation data is just really, really robust. We're showing still a lot of strength in inflation, and we're not at that low 2% level that the Fed's been targeting. So this is what we got, right, Anthony?
Yeah, and I really think Fannie Mae probably has the most realistic perspective here on this. Now, today we're at closer to 7.5%. It's been a rough couple of days, but or a rough couple of weeks, really.
Yeah.
But realistically, I think we would be lucky to see under 6.5% by the end of the year. But if it starts to trend in the right direction, it could fall pretty quick.
Yeah, so, and
it's just hard to say.
Before the year, right when the year began, we were like seeing some people think it'd be about 5.9 or whatever. We felt it'd be right around 6 or a little bit above 6. I think we're revising our own forecast to be more like 6.3 to 5 to 6, kind of range.
Yeah, it's going to be real hard to see, but until those inflation numbers come down, the Fed will not budge, right? Yeah. They're not going to do it.
I could see them doing one just to test the waters, just to placate some of the people right there, and
like November.
Yeah.
All right. So demand based on the environment. So this is the rate over on the far left side at 7.5 at the top, and it just shows buyer demand gets really, really soft above 7.
Yeah.
But in all reality, for us to get back into good, which is where we would like to be here in Colorado. I think we have a ways to go, right? 6.5% is pretty tough.
Yeah, as you said, Anthony, we're at like 7.5% today, so we're right at the top of that red line, and really, history says we've got to be under 6 to really get buyers to not think about the interest rate as a factor when it comes to financing.
All right, so what about the home price forecast? This is going to be all over the board, as you can see here, everywhere from 5 to 1.4% from NAR.
And, last year we ended nationally about 3.8 or 4%, I think, roughly. And so we're kind of in that same rough ballpark with, a blend of all these here right now. I think Zillow nailed it pretty well last year. So my money's on maybe them, continuing again a little bit with this. You got the big brain trust of Goldman Sachs, which, smart guys too. But, Zillow's got that really on-hand data that they could see a day in, a day out basis. So somewhere in that realm.
I think so too. All right. So what about this one? You're going to explain this one.
Well, Anthony, this is our thesis, right? This is every year we hammer this point home. We do not have enough homes in America. That is the fact, right? And so different prognostications say different things, somewhere in that 2 to 6 million range. But this is from the Census Bureau and Moody's data coming in at a deficit right now of 3.2 million homes in America. So we need 3.2 million more homes. Shake your pockets loose, folks. Try to find an extra home under your mattress or something, but we need more. And so this is, where we're going to continue to see that upward pressure on prices, right? To see more and more prices increase,
right,
even though we don't have as much in the way of sales volume. So that deficit is what's driving the prices to increase.
All right. So Jim pulled this together, and this was astounding to me. So if you look here, 1969 and current are the most similar years in housing starts that he could find. And the interesting part about this is the population in 1969, we looked this up before we started, was only 200 million in America.
Yeah, so it's about 40% less people in America. And if you look at the month over month, housing starts at 69 versus 2023, very parallel to that. And honestly, if you look at 2023, that was the highest numbers we've had in over a decade as far as housing starts go. And with the, economic climate of interest rates, low inventory, I don't see the housing starts even matching 2023, at all. And so we need years and years of overbuilding. We're not going to be getting it. And so continuing to see prices increase, I think, in the long term.
Absolutely. Now, if we look at change in inventory, this one's really fascinating. So there's some weird, really wild anomalies here.
Yeah.
Normally, you see a place like Las Vegas and Nevada to be one of where we see changes in inventory and changes in prices, maybe the most extreme.
Very sensitive to the
very
economy.
Sensitive, right?
Yeah.
To the economy. And here we are where for some reason they're taking the cake at the lowest inventory change in all of the United States. Actually had an inventory increase.
Yeah. They have the least amount of homes for sale per capita. It's just remarkable. But then when you look at Florida, not too surprising because it's been nothing but negative news coming out of Florida man all year, right?
Yeah, I mean, insurance companies are pulling out all over the place. You just have people walking away from Florida, and that's
HOA costs. I mean, HOA and insurance, taxes, all that stuff. I mean, you're looking at triple, quadruple, your monthly HOA costs and your property taxes and your insurance rates.
That's brutal. So what about Illinois and New York?
Well, I found this interesting because last year they both registered a net outflow of people, residents leaving each state, and they tended to go to that, Sun Belt, specifically to Florida in a lot of cases. Mm-hmm. But here you're seeing less for sale in both of those states, which kind of means that people are not willing to leave as much this year. So there seems to be a stabilization in those areas of outflow because maybe it's just a bad press of, the Sun Belt with, their increased risk of, climate change.
All right, so this one is kind of a little different than what we would normally talk about, but it plays into the housing so well. We wanted to talk a little bit about consumer price index by state. You can see there Colorado at 2.94%. We're kind of right in the middle of where it looks like the U.S. is. The one thing that really stuck out to me here is that the places with the highest CPI increase, right? This is inflation, basically, is Florida, Georgia, Alabama, Sunbelt, Texas, and California, right? So these really, really large metropolitan areas across the United States is really creating some issues nationally.
Yeah, because there's like a 3.8. The CPI came out last week, I think at 3.8 is what it was. And so here in Colorado, you can see that we're below the national blend of it. But as Anthony said, it's really some of these, highly populated states like Florida and California that are above that, and Texas that are driving it, that are really skewing the numbers, if you will, because a lot of the other states, it's not quite as bad.
So we're kind of at the mercy of everybody around us, right?
Yeah.
And we see this a lot in the national real estate market. Yeah. All right, so this one's kind of fun. What's going on here?
Well, this is, how much Gen Z will be paying in rent by the time they're 30 in 197 different metro areas. And so you can see like on that, like the lightest, the blue of the spectrum, it's under $100,000 they'll spend on rent cumulatively until they're 30 years old. And then on the far end is that bright orange where they're going to spend over $250,000 on rent by the time they're 30. And as you can see, it's the Bay Area. That's really, holy God, man. As Anthony was saying, like if you're not one of the tech bros making a huge stock performance package, you're really getting screwed.
Yeah, you might want to be a barista somewhere else.
Yes. Yeah. And, as you can see too, what's interesting about this is just that it follows along with the values of property, essentially. The coasts have the highest values typically in home prices, and Denver, the metro area, right? The Front Range is the other island always that
and
does.
That one little dot down in Texas, you said is what, Austin?
Austin, yep, that's Austin.
So that's not really that surprising either.
Yeah.
Obviously, Hawaii is pretty expensive, but just kind of goes to show you where people are spending the vast majority of their money. But the interesting part is these are also the places where people are moving the most.
Yeah, and it's also just parallels with the property, values cost the most. So it's not too surprising, but it's kind of shocking, I think, to think about the cumulative cost of rent if you're in Gen Z right now, what you're spending.
Yeah, I think so. So here's the takeaway from today's podcast. This is our last slide. I think the most important thing is go buy a house if you're a renter.
That's a good point, Anthony. It's a good point. Yeah. So again, I'm Jim Marion. I'm a realtor here at Coldwell Banker. You can call me at 303-548-0243 or shoot me an email to jim@ourcoloradohomes.com.
And I'm Anthony Meisner with Land Title. You can reach me at 303-968-9868 or ameisner@ltgc.com. Don't forget to tune in to Colorado and our local forecast. We're going to be talking about those soon. So tune in next time.
Have a great one, folks. Take care.